It's a tale as old as Wall Street. A company smashes expectations, yet its stock price tumbles. This is the perplexing reality that Nvidia investors faced, and it reveals a critical lesson about market psychology that everyone should understand. Nvidia, the undisputed titan of the AI chip world, delivered a stellar quarterly performance that on paper should have sent its shares soaring. They reported earnings that beat analyst forecasts, issued revenue guidance for the coming quarter that was also above expectations, and even announced a plan to buy back its own stock, a classic move to return value to shareholders. And yet, the stock fell in after-hours trading. This seemingly irrational reaction is where the real story begins. But here's where it gets controversial. The entire drop was triggered because one single segment, albeit a crucial one, narrowly missed its target. This raises a provocative question. Have we become so obsessed with artificial intelligence that we're blinding ourselves to a company's broader and still incredibly robust health? The specific figure that spooked the market was the revenue from Nvidia's data center division. This segment is widely viewed as the most important barometer for the company's AI future, as it includes the powerful graphics processors, GPUs, and related systems that are the essential engine of the AI boom. The division's revenue grew an astonishing 56% from the previous year to $41.1 billion. However, that figure was just shy of the $41.34 billion that analysts surveyed by StreetAccount had been anticipating. This tiny miss for a business unit of this colossal size was enough to overshadow all the other positive news. And this is the part most people miss. This reaction might be completely overblown. It's vital to step back and look at the bigger picture. According to data from FactSet, Nvidia has a near-perfect track record, exceeding earnings estimates in 11 out of the last 12 quarters. Interestingly, its shares have still fallen following the results on 4 of those occasions. This pattern suggests a fickle market where even phenomenal success can be punished if it doesn't meet stratospheric and perhaps unrealistic expectations. This leads us to a crucial and often forgotten part of Nvidia's identity. Before it became synonymous with AI, Nvidia was a gaming company. Its gaming division was its largest revenue driver, famous among PC enthusiasts for its top-tier graphics cards that gamers eagerly install to power their immersive experiences. While the data center business is now the giant, the gaming division remains a significant and stable engine for the company. The old saying warns against missing the forest for the trees. In this case, investors risk missing the immense and diversified forest that is Nvidia by focusing solely on the towering but single tree of AI data center revenue. The company is far more than a one-trick pony. In other market news, the S&P 500 climbed 0.24% to a fresh record closing high of 6,481.40 as investors remained optimistic ahead of Nvidia's earnings report. Asian markets showed a mixed performance, with Hong Kong's index leading losses by falling over 1%. In geopolitical news, Japan's top trade negotiator unexpectedly canceled a trip to the U.S. for discussions on the trade deal between the two nations, citing a need for further technical discussions on certain points, including U.S. tariff measures. On a brighter note, Australian airline Qantas saw its shares surge to a record high, jumping over 13%. After its full-year profits soared on the back of incredibly strong travel demand. Finally, industry professionals are weighing in on Nvidia CEO Jensen Huang's recent comment that buying stock in TSMC, the world's leading chip manufacturer, is a very smart move, offering their analysis on whether investors should follow his advice. So what do you think? Is the market's intense focus on a single metric a rational way to value a technological powerhouse? Or is it a short-sighted mistake that creates buying opportunities for savvy investors? Have we placed too much weight on the AI narrative and forgotten how to evaluate a company on its total merits? We want to hear your opinion. Share your thoughts in the comments below.